This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the podcast, I have Salem Abraham. He is the president of Abraham Trading Company with a lot of trend-following success. Over the years, Salem has been kind enough to offer me fantastic insights. I'm very fortunate. I've been to his hometown on several occasions. Great place to visit. Great steakhouse. Just awesome. He also appeared in my film, Broke, and is the last chapter in my book, The Complete Turtle Trader. Today we cover some topical market moves, Swiss Franc and oil among them. I hope you enjoy this conversation with Salem Abraham.
Hey, Michael, how are you?
Hey, Salem, how are you?
I'm doing well. Good morning. Good afternoon to you. What time is it over there?
I'm at 10:15 p.m.
Wow. So good, almost good night.
Yeah. But this is called podcast dedication. So,
good.
It's a perfect time for chatting and catching up. So hey, how is economic development in Canadian these days?
Well, with the oil and gas market going off the cliff, it's kind of sliding. So it's, but now it's really been booming the last 6 years or so.
Yeah.
So yeah, it's been blowing and going. I guess it took a little bit of a hit in 08, 09, late 08, early 09, but then, that seemed to recover pretty quickly. They kind of transitioned from drilling a lot of natural gas wells to then oil wells, and now both oil and gas are both low, so they're kind of, they're really, the drilling's slowing down, and everybody's kind of scratching their head. But things are, it's still a nice town. It's still good by my standards. So,
well, hey, I miss the bread pudding at your steakhouse down there. So
that is good bread pudding.
It is. I
agree with that.
Absolutely.
Yeah, it's nice. Are you okay? You're doing fine. You're enjoying. You're living in Singapore now.
I'm in Saigon right now, in Vietnam right now.
Okay. Now, are you living in Vietnam?
I don't know what the definition is. I've been in Asia for the last 2 years. I essentially did a huge speaking circuit, and I did not plan to stay after 4 months of speaking in 8 or 9 countries and 45 presentations later. I was like, wow, I really don't want to go back to San Diego at this moment.
Yeah.
One thing happens, and then the next thing you know, and so it's nice.
Good.
It's nice.
Well, a lot of people really love it over there. I know I have a friend that talks highly of Singapore, and so I know there's a lot of nice places over there to spend time, and it's interesting cultures, and so yeah, they've
really the econ development, they kind of reminds me of the feeling that the boom periods you've seen in Texas, but I would think of even the 1980s booms in America. It somewhat feels like that the kind of just growth. It's exciting.
Good.
Yeah. Let me ask you not the tough question, but the interesting question that I think has probably been something that near and dear to you. I remember having a conversation with you talking about your Euro-dollar lessons from 1987. I think if we bookend that with the Swiss Franc, it probably have had to brought back memories, that type of a move, huh?
Yes, absolutely. It did. So October 20th of 87, so I'd been trading for 2 months. And we had the crash on the Monday the 19th, and then on the 20th was a 90-day Euro-dollar interest rate move. It was a 37 standard deviation move based on the prior year's volatility. The Swiss Franc move that we had recently was a 45 standard deviation move based on the prior 100-day fall. Yeah, it kind of makes me smile, and it reminds me of a lesson I learned back in 87. Which was, be careful with a lot of standard risk measurements, like standard deviation and variance, when markets are not always, markets, we're applying something to markets, a statistical measurement to markets that is generally applied to things naturally occurring out in the world, like the height of people or the amount of rainfall or, things like that. And so you then come to these markets that sometimes are not completely natural, and certainly the Swiss franc wasn't, and even to some extent the Eurodollar interest rates weren't. Short-term rates, governments can change, and if people are involved, and it may not be occurring in a normally distributed fashion, and the same with FX exchange rates. So, no, it did, and it reminds me that the other big thing is in these markets, you've got to always be careful and trade small, and not get too far out on a limb, because there's a few players out there that can saw off limbs, and you don't want to end up smashing to the ground like it happened. So, and interestingly enough, Michael, I was on the wrong side of both of those trades. I was on the wrong side of the Eurodollar trade. And back then I was trading a lot bigger because I hadn't quite learned the lesson. So anyhow, that was the worst day of my trading career ever, where I lost half my money in my account. It was a $66,000 account, went to 33 on October 20th of 89 after, 2 months into trading. But the lesson was a good one, and it came at a great time in my career because I've never traded an account so small since either. So fortunately, the Swiss franc, it cost our clients and me about 2%, but still we have had a great month. There were a lot of other things make money. So we're finishing this month up about 4.5% for January of 2015.
It's interesting. You bring up the percent loss on the franc. I can't tell you how many emails I received, I guess from people that perhaps don't understand generally the systematic quant trend type strategies. So many emails came into me immediately assuming that any leverage employed in the strategies that you employ, your peers, that somehow or another that all these folks had blown up. And I was thinking to myself, like, hold on, how in the world did systematic quant trend type strategies with sound risk management, how are you equating this with FX brokers using 500 to 1 leverage?
Right. Yeah. Swiss franc is one of 60 markets we trade. So, and the one part of one key component of a trend following strategy is broad diversification and small risks across lots of markets. And so, it's very different from people who just trade in say it's just a currency trader, because a currency trader, if you're not diversified, you got to have concentrated positions, and that's the people that can get hurt worse. And we really, for us, our Swiss franc trade was a somewhat large position for us. So, so it was, and there's no getting out of the way, that kind of move. It's just slaps you upside the head, and you don't, by the time it's over, you've taken your losses. My guys called me at middle of the night, the trade desk, we've got a 24-hour trade desk, so the folks called me, and we looked at it, and it's a little bit, you've got to prepare for things like that before they happen, and you don't know when they're going to happen. Once every 5 or 10 years, you're going to have a crazy event happen that you just hope you stay out of the way of, and to the best you can. And so a key component is always, take small risks, and they seem tiny, but whenever you get something like that Swiss franc move that happened, even a tiny risk looks big. 2% loss, that's a big loss for us, in a year. That's a big one. It'll show up as one of the worst markets for the year at that. So our best markets are, for the year will be in the, 3% range, and the worst markets are usually in the 2% range. And, and most markets are in a fraction of a percent. You're making 0.5% to 1.5%. And it's like climbing a mountain. You do it a step at a time, and you get there a step at a time. There's no big giant leaps in the way we do things.
But you had to have smiled, though, because 2%, yes, you did not want to lose 2%. But on the flip side, there are people out there that perhaps will go unnamed or unnamed funds, whatnot, that you and I both know they are sitting there in tatters right now. And I'm not gloating or anything like that. I'm just saying that ordinary risk management strategies have left multiple funds out there, perhaps we'll never know who they are, probably broke.
Oh yeah, no, yeah. If you made a lot of money, you're being quiet, and if you lost a lot of money, you're trying to be quiet, but it's going to be hard because at some point dead bodies rise to the surface, and people end up seeing it. But no, to me it made me smile just the statistics and these risk measurements that you see people apply to markets. And I'm on my 28th year of my career in trading, and I see these people that they bring this nice box of statistical measurements from academia, and they try to apply it to markets. And I'm always like, look, this will work for a while, but there'll be at least once a decade you can throw all that in the trash, and they're going to throw something at you that you say should never ever happen. And just know things that should never ever happen do happen in the markets, and that the markets, particularly when you get into currencies and short interest rates, those are the two that are the scariest, in that the volatility expansions historically have been the greatest. And you see the importance of risk management from a whole nother level than they taught us in statistics class, and the only way to do it is trade very, very small, and don't get too greedy at any one trade or any one moment. Just always be fearful of those coming along, because they end your career. And so, you always got to smile when a bullet zips over, and you say, okay, that's why we don't stand tall in the markets. We kind of hunker down and don't get too big.
Let me ask you one last little question on this Swiss franc topic. So, an artificially priced market like the franc, and I think the analogy, a dam building up. And so can you talk about the notion of these artificially priced markets? Now, of course, you're not in the business of making predictions, but you structurally also are well aware as to how markets are situated and how governments can participate unexpectedly. Talk about the notion of these artificially priced markets around the globe and how these dams can get built up with a certain amount of pressure.
Well, I like your dam analogy. I used that same analogy recently about a dam because, I was talking about 100-year floods, and statistics, again, are designed to measure, these statistical tools are designed to measure naturally occurring events or situations. And so it would work with, say, a 100-year flood, and you would say, okay, well, 3 standard deviations and this kind of thing. And, 99.7% of occurrences should be inside of 3 standard deviations. And it changes when you get people interfering in a naturally occurring event. It's very similar to if you build a dam. And so if you build a dam on a river and then the dam breaks, it's a very different flood than the 100-year flood that would have occurred. And it's much more catastrophic. And I think, in the markets we see that, in, the interest rates with, the central banks around the globe, they've got the interest rates in a headlock, and they feel pretty confident they can control those interest rates. But, we've all seen markets where central governments tried to control things and they didn't do a very good job, or they did a good job up to a point and then it broke loose. And that's what happened on the Swiss franc. The bankers here at Swiss National Bank had to be sitting around as they're printing these Swiss francs, trying to keep their currency weak, and it must have seemed really silly, the quantity of Swiss francs they're printing, and they just look at each other and say, we just can't keep this up. And then you break the dam. Then how do you break a dam? How do you once you've got all this water backed up, there's not an easy way to let it go. There's a lot of ugly ways to let it go. And so they just picked the easiest one and just walked away and let the whole thing collapse. And it's dangerous for traders when you've got people interfering with markets. And, most markets, you don't have that. You get markets like, say, the grain markets or cocoa or the metals or energy markets. They just swing around and they're wild all the time. But you get someone with a market in a headlock and everyone gets you lulled into this sense of complacency that, oh yeah, this isn't very volatile. But you got to be careful. It's kind of like dynamite. Dynamite's not volatile till it goes off, and then watch out. Yeah, so it just sits there, looks real innocent until boom. And so that was the Swiss Franc, and it was interesting in '87, the crash of '87. That when your dollars, I mean, that was central banks moving interest rates, dropping. They lowered interest rates, but to help flood the market with liquidity after the crash, on October 19th, and so it wasn't quite the same deal, but it was in that they went and had a big splash too with doing it, and again, a move that should statistically never ever happen. And we certainly see other dams built up out there that you've got to say, okay, be careful of those. Same thing can happen there.
I want to jump into in a few minutes here just some background stuff and lessons learned and wisdom you can impart to the audience. But there's one other market move that I think is really interesting to talk about. Crude oil, basically since last year, a fantastic trend, at least if one's on the right side of it. But I think what's really interesting, I mean, you're a dyed-in-the-wool speculator. I mean, you are a speculator. That's what, your business is about, speculation. And of course, running a money management business and helping clients, but at the root, it's speculation. And speculators often get an awful name in the press and whatnot. But this time around for oil, I don't hear people coming out and saying, well, gosh, thank you for the speculators for making our gas cheaper at the pump.
Yeah, no, and for the most part, you had a lot of, certainly the trend following community, they were short energy markets, and no one sent a thank you note. They were sure trying to villainize everybody when it was going up. And what I always tell people, and I think if you really think about what happens in a market, I think if we start with the premise that a market is driven by supply and demand, and if everyone can agree on that, you say, okay, which I think we can, because I think that's true. If the supply of a market and the demand of a market, that's what ultimately determines the price. Well, and to affect the supply, you have to, if there's some shortage of let's say, for instance, let's talk about crude oil back when it was going up. If there's a shortage of it, then someone must have taken that supply. And to take the supply, someone either has to consume it or they have to hoard it. Those are the two ways to take supply off the market. In order to consume it and hoard it, you have to take delivery of it. And if you see people in the futures markets, speculators, they don't take delivery. They roll forward. It's really silly for people to say, well, it's all your fault. And I would say speculators could push a market for a day, maybe a week, but eventually that contract comes up to maturity and they've got to sell it. In the end, they just held it for a bit. Say, you look at times when people have manipulated markets and cornered markets. If you ever corner a market, you've got to stay in the corner with the market. You can't walk away with money because then you've got to sell. You only make a profit. You got to buy and then sell. And if you ever corner a market by buying, then you ultimately have to sell to make money, and you can't artificially create demand or artificially hurt supply if you never consume it or hoard it in a long-term way. And so speculators changing the market, I mean, it just doesn't happen. It happens on a very short-term basis. There are moves that are fundamentally, there's a reason for them to happen. They happen, and speculators get in and they participate in it to a degree, but to make a profit, you've got to sell to someone else that wanted it worse than you. And the speculators are not selling to always other speculators. They're selling to people that really want to use the product. And so, it's a silly argument that you hear lots of times from people that don't understand markets and they want to blame someone for a movement. But like you say, they certainly never go give credit to anybody when it moves the way they like it to move. But at the end of the day, you can try to educate people, but you can't fix stupid. And some people are intent on being stupid, and they don't want to be educated, and they don't want to take the time to learn. And that's a harsh way to put it, but that's just, that's what you see.
Let me take you back a step as you mentioned learning, and you're a guy that was fortunate enough to have some really interesting mentors early on. And I think one of the most interesting mentors, and we've talked about this in the past, was your grandfather. And I would love for you just to, reaching back into memory and impart some of the wisdom to the audience that your grandfather was able to impart to you just about life and markets. And because I'm sure you probably think back every day and think, well, gosh, this guy's, has a good part of my success and he helping me to learn and think the right way.
I was really blessed to get to work with my grandfather and for 6.5 years before he passed away, which has been almost 21 years ago. He's been gone a long time, but he was a very successful business person and doing, deals mostly. And one of the things, I think one of the best lessons he taught me for anybody in business is we were doing some land speculation. So we would buy, it's almost like, and this was in the 80s when the oil and gas boom of the 80s had gone completely off the tracks, and a lot of land was being sold cheaply. And so being in the country, we were buying distressed real estate, but it's ranch land, and a lot of people in the housing world are doing that in housing, kind of fix and flip crowd. It was basically the country boy version of that, but you do ranches. And we liked ranch land, and my brothers were involved in ranch land. Well, so there were deals we had the opportunity to buy into some deals, and they were probably, 85, 90 cents on the dollar. And I really wanted to do those. And he said, no. And I said, look, we could make some money off this. And he said, yeah, but I said, look, we don't want to do good deals. We want to do great deals. I said, don't do good deals, because when you do good deals, you tie up your time and your energy and your money. And when the great deals come along, you don't have time for the great deals, and you don't have the money for the great deals. So you got to keep your powder dry for the great deals. The patience he had, and as a young person, I was anxious to do something. And he laughed and he said, you need to get a hobby, relax a minute, wait, wait for the great deals. And he was right, because, a few months later, a deal comes along that's, 60 or 50 cents, 50 to 60 cents on the dollar. It's actually 50 cents on the dollar. This one deal came along, and a bank had some property, and they had to unload it fast, and they were looking for someone with cash, and we had it. And so not doing good deals was interesting advice, but really great advice. And you see that resonate with other people. I know Warren Buffett, a terrific investor, he's talked about, if you can do 10 great deals in your lifetime, this, like a coupon book, I think he describes it as. So great deals, that's one. Certainly the other big one that, and the very first thing he told me when I showed up is, just the importance of honesty and ethics and treating people right. The world's built in a circle, and you got to go treating people badly. Then at the end of the day, that all comes back to you, and you're not going to be in business very long. And it costs you in the short run to do the right thing, but it pays big dividends in the long run, and to demonstrate to people you're trustworthy. Those are probably two of the best ones that he had. Now I will say he tried to do deals with a lot of optionality to them, where the risk reward, and I would say it's similar to trend following in that where you limit your losses and have the opportunity for big profits. He would do that with options, where he would, make a deal where he pays an amount, just like an option premium, and then he's got this upside that he sees it's a lopsided return with a limited risk, and where you control that downside, and that's certainly something that transcends from the business world to the trading world. But so does, certainly honesty and ethics. That's important as well. And so, and even the importance of the big deals, that's, you see that in trend following. That's where you make your money, is some of these nice big moves. You make it in lots of little places, but these bigger moves, if you can get a handful of nice moves that, 2-3% moves that give you 10 to 15% a year, you say, hey, that's a good year. And I was really fortunate and very blessed to get to work with him.
Going back in time and going back to think about your grandfather, but I'm curious, in current day, what influences you today, your thinking, your business decisions, whether it's new voices or thought leaders, books, what types of influences affect your decision making today? What new things do you like to learn today? I'm giving you the hard question right now in the middle of the interview.
That's all right. Well, I love to read, and the other day I read on the plane, 0 to 1 was an interesting, you read these books from smart people like, that's Peter Thiel, and I like reading about people who've done it. I think that's what's interesting about what you do, Michael, too, is I think to listen and to talk to people who've done it. There's a lot of people that will come up and say, hey, let me tell you how to do this, but they really haven't done it. And anytime I can learn from people who've had interesting experiences and have done fascinating, amazing things. And that's fun to read about. And that's where, like I said, that book, that Peter Thiel, that's just one of many examples. But he's done some interesting investing and analyzing businesses and what works, what doesn't. And so, anytime you can study from people who've demonstrated they can repeat success, there's sometimes the one-hit wonders that you go, well, I don't know if that was just one lucky, got a hunch, bet a bunch, and then you're out. You see that sometimes. But sometimes a lot of times you'll see people that you say, all right, these people have demonstrated repeated success, and they've got something that they've got some ideas or concepts that seem to work. And so anytime I can do that, I will, like the old, the Market Wizard books, Jack Swagger used to do. Those were interesting way back. What you're doing, where you talk to traders that have done it, all that. And to talk with other traders, that's always fun and interesting to see different people doing different things. And, at the end of the day, some people, they're doing something that I may never like to do. It just doesn't fit my personality. But it's still fascinating to hear about it. And you've got to respect success wherever you find it, whether it's in the investing world or in an athletic endeavor or in the arts or whatever. You see people that are that really seem to connect and have an understanding, and it's fun to just at least learn about what they're doing and what they're thinking.
I always give you a shout out because the one thing that, here I am in Asia right now, but what I think I really learned from meeting you and seeing your home, your office, was the location independence. And you had that feeling and thought as a young man, but I don't think a lot of people necessarily have that. And you chose to be in your hometown, but I, coming to your hometown, just said, well, hold on. This just means you could be anywhere. That was an awesome lesson I got from going to Canadian Texas to actually give me the confidence to say, well, gosh, I could be in Asia. Why not? And people might find that funny, but it's true. It's the location independence aspect.
Yeah, no, I agree. Well, all you need is some way to connect to the outside world. It was, our town in Texas is somewhat a typical Western town where the railroad came through, and the railroad came in 1887 to our town, and that's why the town of Canadian Texas, that's why the town's here, and that's where the railroad was the link to the outside world. And today the link is either a satellite link or phone link, and so the links are not as expensive to build as they used to be back in the 1880s with railroads. But that link to the outside world, whether it was, in the Old West, the railroad, or today with satellites and phones and internet connections, yeah, it's easier today. And it's that same link, you need a link to the outside world. And it's easy to get that from a remote location, whether it's a small town in Asia or a small town in Texas. Most of them have a link to the outside world. And once you have that, you can do a lot. I think you can do anything, particularly in the trading world. Why not? And, what I found, I like being a little bit removed from all the noise, and I can sit and study and run my numbers and see what I'm wanting to do. It's kind of like studying in a quiet room, or do you want to study in, Grand Central Station? And if I'm studying and really trying to think, I like a nice quiet place, and I don't need the distractions. So Canadian serves as that. It's really a nice place to study and work, and then I've got that connection and hit a few keystrokes and make some trades. And so, no, you're right. You don't have to be in the middle of Manhattan or Chicago. And to me, it would be a distraction. There's too many things going on that would get my attention, and I'd just say, nah, let me just get out where there's not a lot of noise and not a lot of people, and I can think clearly. So, and good fresh air. So,
yeah. Hey, as we wind down here, let me get one kind of last question about the markets trading. So you've got a strategy that really, one of the key features is it's a strategy that's designed to the best that you can to avoid disaster. And we were talking about it early in the conversation. But talk about the notion of, so here you have this well thought out strategy, very quantitative driven. You want to avoid disaster. But on the other side of the ledger, you have so many people that have been long the S&P since March of '09, and they just say, well, I don't need all that stuff, Salem. What disaster? What are you talking about? Look what the S&P, it's gone straight up. I don't need all the exits and the risk management and the disaster protection. It's always got to be a constant struggle with a strategy that is designed to protect against disaster. And there's no guarantees to anything, but you're always thinking about that. Whereas I think many people in the investment community, and of course you have many peers that think like you do, but many people in the investment community and their clients don't often think of disaster as one of the most important things. And I'm not trying to be a negative guy either as I bring this up.
No, I think you're right. I think people are conditioned they think they have to have, the stock market they've got to have a lot of money in it, and they don't, and they're somehow said, well, we're going to have periods where we lose a lot of money in this market. And I look back at history, and history's important. I mean, history gives you an idea of at least none of us can see tomorrow. We don't even know tomorrow, let alone next year or the next decade. But certainly we can look back in history. And in the very recent history, even '08 and '87, back to, the crash in 1929 in stocks will occasionally hand you a loss in the 30% range, somewhere 20 to 40%. That's not uncommon for once, every now and then to get that kind of a loss in stocks. And I think somehow people think, well, this is just what we're supposed to do. And it's like not wishing for something that could be better. And then also they think that in the way of diversification, what I see too, they do this diversification, have this diversification idea that, well, we want to diversify. On average, we want to be diversified. And so they get this big correlation matrix and they look at, say, monthly returns over time, and they say, well, I'm going to be long this stock, and then whether it's value and growth or different, emerging markets or venture capital and all these different equity components. But at the end of the day, they're all equity and they're all business. And when the world has a big economic downturn, they all go down. And so they say, well, on average, they're not diversified. But then when the whole thing, when the economy really tanks, they suddenly, people have this thing, well, there's sometimes the correlations all go to one. Well, you say, well, yeah, if so many of these investments are along the economy and they get smashed occasionally. And then you see what we do, and you look historically for us. I mean, we haven't been for hundreds of years, but almost 30 years, and our worst year is down, 10.9%. And you think, well, that's not as painful as 30. And then two, you see that we can make money when everything does go down, like in 2008, where we made 30%, and a lot of people in the managed future space, I think the average was up about 15%. And so you see this huge opportunity for diversification. And what I always say is, it's diversification when you need it. A seatbelt that works every day except when you have a wreck. You're like, well, is that really a good seatbelt? If it doesn't work in the wrecks, and who cares if it's working on the average day when I'm not having a wreck? And you say a diversification model of all these different things that are along the economy where, all these equity components that occasionally get smashed, and you say, well, I'm diversified though, it works. It says, yeah, but you're not diversified when you really need it. When you really need it, everything you have all this pain. Why do you want a diversification model that in the wrecks doesn't work? I mean, does that really make sense to anybody? It doesn't make sense to me. I want something that, I want to look at when things all fall off the tracks and we have a really big economic downturn. What are the things I can be involved in and invested in that have a chance of making money and that are not going to get drugged down by this economic collapse or downturn? And that's where it's hard to find. It's a short list of things. Managed futures, though, are on that list. I think managed futures, I think you see global macro, which is really a kissing cousin of managed futures. It's the same kind of thing. Those strategies in the hedge fund space can do well. And I think people doing this type of trading, they can also do well. They can, there's opportunities to make money when everything's going down. In '08, people say, well, how do you make 30% in '08? I said, well, we were short, our biggest trades, which are not big trades like we've talked about, short nickel, zinc, and orange juice. And most people didn't make money with nickel, zinc, and orange juice going down in '08. And then, even in 2014, we were up 21%. We had a great year, but we made money. Our biggest money makers were in the meat markets. We were long the cattle and long the hogs, and then long milk. Those were some. Now the 10-year rates made us some money, and we made some money in currencies too, and so a lot of different things. But it's interesting with hogs, long hogs and long milk were two of our big winners last year. Well, this month we're short hogs and short milk, and milk has been a break even this month, but hogs is one of our best money makers this month, and now we're short. And so it just helps illustrate the point that, hey, things up, things down, we don't care. Things moving, that's what we want. And when things are moving, there's an opportunity to make money. And that gives us also, does the economy going down hurt or help? We're like, well, actually, if the economy really thinks big, it's probably going to be a nice big move. And nice big moves we can make money off of, like '08. It's a great diversifier. It is funny how people somehow want to accept a 30% drawdown in one investment class, and they're happy to put 60% of their money in it. But then they look at futures and they say, oh, it's risky. And you say, well, it doesn't have to be risky if you trade it right. Just like a Lamborghini. If Lamborghini can drive around 5 miles an hour everywhere. Just because it can go 200 doesn't mean you have to drive it 200. And the same with futures. It's got huge leverage, and that tends to scare people, the opportunity for leverage. But it's truly like driving a Lamborghini at 5 miles an hour. And people, we just don't use the leverage. It's like, well, it's got a lot of speed there. We could use it, but it's dangerous to drive fast. We don't like to drive fast. I think it's a good point. I think you make a good point, though. People should look harder at managed futures and the opportunities. And I think they're beginning to. You see more and more people, even big institutions, looking at it and seeing the opportunity for diversification. So hopefully that continues.
I think some people, maybe they want to make money in a certain market. And you wake up each day and you say, hold on, I'm going to manage my risk. I'm prepared to make money from whatever market moves in the direction that I'm going right, or the direction, following along the direction of that market. But you're agnostic. You're not waking up and saying, I must make my money in Apple. I must make my money in Google. You're not doing that.
Right. No. People ask me, well, what do you think is going to be the big markets in 2015? I'm like, I've got no idea. I said, but I'm ready. You've got to be there ready. And like you say, do we care? No. Do we care up or down? No. We care that there's some movement in a market someplace that we can see taking place and jump on board. And so, yeah, it was last year, meats and milk and some currencies. What's this coming year? Who knows? And the energy market's down. Maybe energy market's up. Maybe we have a drought. Maybe, in 1988, huge drought, grain prices doubled. Maybe, who knows? Maybe it's something in the softs. Maybe it's orange juice. There was a year orange juice and base metals made me most of my money. It can be anywhere. You're right. And it can be up or down. And I've made, having done this so long, I've made it lots of different markets and every up, direction's up, direction's down. It really is. You're not limited to one space. And you mentioned like the currency traders earlier. Some people some people even in the futures markets will limit their space to one sector. You get people that just trade energy, so just trade currencies, and that to me is tricky. You're like, well, if you're just trading, say, energies, what if the move's in grains, or what if it's in cocoa or sugar or coffee or the metals? Or so we trade 60 markets. We're looking for 5 to 10 good ones every year that are really going to shine, and that's all we need. But you want to kind of have a big group in the room that you can say, all right, who's feeling like doing a big move this year, and that's what you need to make your year.
Question: Have you, as we kind of close out here, have you visited this part of the world? Have you been over to Asia yet?
I have. I went to, I have 8 kids, so we've got a whole tour group all in our own family with 10 of us. So 8 kids and my wife and I. So we went to China. It's been 3 years ago, and we did a big 20-day tour of China, and it was an amazing trip. We really had a great time, and wonderful people, interesting economy, and the things that people are doing, and a fascinating area. Would love to see more of Asia, because I know there's a lot of other places outside of China that are doing fascinating things. I know, like where you've been in Vietnam and Singapore and different places.
Once you see China like that, though, unless you're talking to another American that's seen what you've seen, it's almost hard to explain what you see on the ground, isn't it?
Oh, I agree. Well, you see what's in the news, and the news is not everything. The news is the interesting things or the shocking things going on, but the real life is everything. And so I think that the keyhole of the news stations is not the keyhole. That's not the full picture. And so to go meet people and to talk to them and to go in their house and eat, we would go and eat dinner with them and talk to them and understand what what they do every day and where they go to work and what their routine is and where they shop, go to the grocery stores, which they don't have. They have these markets, and you go and you buy things there, and it's fascinating. And it's just, you see their way of life and what they're doing, and then you have a better understanding of, okay, I see what's happening here. And, certainly with the number of people in Asia, they are a big factor in the world and what they're doing. And it's like our family of 10. If we come eat dinner at your house, or if a family, of 3 come over, it's a different different environment. You got a lot going on with a family of 10, and you got a lot going on in Asia with a lot of people. And with a lot of people, you can have some interesting things happen. So no, it's fascinating. I know you're having an interesting time over there.
I got to share with you one quick thing that you would love to hear. So at 13, I had a chance to present to, I think, 5 of the top 10 largest Chinese mutual funds in their offices in Beijing, Shanghai, Guangzhou, Shenzhen. I think it was in Beijing. It was China Asset Management, which I think is the biggest. And so I'm in a room giving a trend following presentation to 30 guys. And of course, you're in a money management facility like that in Beijing. These are probably the smartest guys, some of the smartest guys and gals in China in the room. And there's using a translator, so they're not giving any indication of English. Okay, when I'm done the presentation after 45 minutes, all of a sudden I start getting peppered with questions in perfect English, right? And the funny thing is they all knew about this one Chinese investor who had made billions, and his whole strategy was buying right as markets were about to kind of lock limit. And so they were all, it was traveling around and giving presentations in all the different countries. China was the one country where they really seemed to have this idea of buying strength and selling weakness, a deep understanding and appreciation of it. They had known other Chinese investors, kind of a modified type trend following strategy, but they really got it. It's going to be interesting to see how things unfold.
You bet. Well, you see in China, I was always amazed at the interest in really entrepreneurship and business, and from the farmer that's out with his little plot of land, or someone that's doing something in the cities. There's a lot of entrepreneurs in China. That entrepreneur mindset is alive and well, and people tend to think, well, this is a communist country, and I'm like, you go grassroots. This is a country of entrepreneurs, and so I could see that, and I could see they're fascinated with markets, and there's a lot of very interesting people there, and like you say, a lot of smart people, smart people.
Yep.
When you as a statistician, I know if you have 10 people and you find the smartest person out of 10 or the smartest person out of 1,000, you're going to get probably a smarter person out of 1,000. Just you've got the odds of a really unusually smart person, and so when they go pick out the smartest of their bunch, they've got some really smart folks that are, I'm sure, going to be doing some interesting things going forward. And so, and very friendly people, and really, we felt, we were very welcomed there. Yeah, it was fun.
Well, thanks again for coming on, Salem. I appreciate it. It's been a while since we chatted. Hey, Asian Godfathers by Joe Studwell. Great book to read about the development of various parts of Asia. Great stuff. But hey, thank you for coming on today. And, hopefully we can catch up again in the not too distant future. And I think people always love hearing your wisdom, and you got great experiences and a lot to learn from. Appreciate it.
Great, Michael. Thanks for having me. It's always fun to visit with you. I appreciate it.
Okay. Take care, Salem. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash, or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.